updates with the mask on because there's so much stuff out there that we don't know what's going on. Just a joke aside. Let's unmask and talk about what the hell is going on in the markets because everybody's just talking so much nonsense that we need to clarify things out. So, for example, let's start from the top and give you guys a viewpoint. You should never underestimate the consumer's willingness and ability to spend, right? Especially if they have jobs and money in their pockets. So this is always a good rule of thumb, and it holds up really well today. On that front, the current economic environment remains super favorable than what we had anticipated despite the highly restrictive monetary policy from the Feds and the tighter bank credit standards, okay? So most of the fundamental underpinnings for sustained real consumer spending growth they remain in place, and that's good. We will continue to support consumers' willingness and ability to spend into Q2 and beyond. In our view, professionally, February employment reports laid to rest the idea that January's strong start for the year was just a one-month seasonal adjustment fluke. Non-farm payroll growth has accelerated this year, so now we're looking at payrolls that rose on an average of 212K per month in Q4. But so far in the first quarter, the average monthly payrolls have increased at a 252K per month pace. So we're expecting really this first quarter of this year, 2024, to be the best performance in the U.S. job market since the second quarter of 2023. So what does this also entails? Well, consumer confidence is on the rise too. Despite a small drop in February, the Conference Board's Consumer Confidence Index in the first quarter is still running well above its fourth quarter average from last year. So the final piece of the puzzle is real disposable income. So it was a flat in January as inflation surged, but we expect positive growth in the months ahead. Private average hourly earnings are expected to increase at about 4.2% in this quarter. All right, people have asked me, what about this FOMC meeting coming up? Pause persists amid the quarter hints. Now, the Fed should keep policy rates unchanged for the sixth consecutive meeting after signaling so at the last conference. The target range for the Fed funds rate was last lifted in July from 5.25 to 5.50, right? 5.5%. As to when it will be lower, the FOMC altered its forward guidance last meeting, saying that it does not expect it will be appropriate to reduce the target range until it has gained a greater confidence that inflation is moving sustainably towards 2%. I call that a lot of bull crap, but I'm not a politician. Clearly, we know what's going on this year by the end of the year. So this is something that most likely is going to happen by the end of the year. So we're not too far from it. So be patient. Inflation. Good things, bad service, right? After January stimulus CPI release, investors waited anxiously for the results of February. While the details weren't quite as hot, the report did nothing to allay concern about sticky prices. So the headline index rose the most in 6 months by 0.44%, lifting the annual rate to 3.2%. Core prices cooled a tad to about 0.36% and 3.8% year to year, but the shorter-term annualized moves are perched modestly above the yearly pace, indicating inertia. So what does that mean? It's all about services. In fact, after 8 successive declines, the core CPI goods prices rose only slightly last month and remained below year-ago levels, while gas prices rebounded and oil has more recently punched above $80 a barrel. So fuel costs are still down about 4% in the past year. Food prices held steadily, extending a slowing trend from over 11% year to year in mid-2022 to almost 2% today. The price of motor vehicles has reversed lower in the past year after the stunt driving during the pandemic. Not so for services prices, however, which leaped 0.5% last month and are still running north of 5% on a yearly basis. This reflects the glacial slowing of still fast rising rent services. Supercore prices rose to 4.3% year to year, accelerating about 6% annualized in the past 6 months and almost 7% since November of 2023. So what are the drivers to beware? Drivers, people that drive, riders, and so be aware. Whatever you save after leaving the dealer's lot could be lost when repairing and insuring the vehicle, which costs up to 7% year to year, 20 and 21% respectively. There also appears to be a little imminent relief in the pipeline for consumers, which with producer services prices speeding up to 5% in the first 2 months of the year, don't expect much of a cool down in the February PCE price report either. Seasonal effects may be warmed inflation data, which in this case, we could see a calmer March report. But if that one lands with a thud, right? Inflation could prove stickier than we ever expected. So what does that mean? The whole EV industry, it's great. It's great in saving energy. It's great that you don't have to worry about maintenance too much. I know President Trump is not too crazy about electric vehicles. Hopefully one day we get a meeting with him and I can explain to him that there is a benefit to it. But other than that, this is my report. And as always, God bless you guys. Connect with me. I'm loving the fact that you're sending a lot of questions and emails. corporate@sorianogroup.com. You know how to follow us in all the social media. It's also Soriano Motori, Soriano Group. And be happy to talk to you guys whenever you need to. So thank you for connecting, liking this, and being a supportive person to us. Cheers. Take it easy.